Alright, let me ask you something. What if I told you there's a trading setup that works 85 to 90% of the time, and you can use it literally any time of day? You'd probably think I'm selling you something, right? I don't blame you. The internet is full of people claiming they've cracked the code. But here's the thing. I'm about to show you exactly how this works. And by the end of this video, you're going to go back and test it yourself. Because when you see it with your own eyes, you'll realize this isn't hype. It's just price action, doing what it always does. Stay with me. This is going to change how you look at charts. Why most traders struggle. Here's the problem most traders face. They have a strategy, but they don't have risk management. Or they have risk management, but their win rate is too low to stay profitable. You need both. And that's exactly what I'm going to show you today. I trade two main setups for futures. The first one is called the breaker structure fair value gap. The second one is called candle range theory. Both of them crush it. But today, I want to focus on candle range theory because it's the one that blows people's minds when they backtest it. What is candle range theory? Alright, here's how it works. And I promise, this is way simpler than it sounds. Step 1. Go to the 1 hour chart. Find the most recent 1 hour candle. Mark the high and the low. That's it. Super simple. Step 2. Wait for price to break either the high or the low of that candle. But here's the key. After it breaks, the candle needs to immediately reverse and close back inside the range. So if price breaks the high, the body of the next candle needs to close below that high. If price breaks the low, the body needs to close above that low. When that happens, something wild occurs. Price will almost always make a move to the opposite end of the candle. Why? Because that's where all the resting liquidity is. Think of it like this. Price fakes everyone out by breaking one side, then rips in the opposite direction to collect all the stop losses sitting on the other side. And it happens 85 to 90% of the time. I'm not exaggerating. How to enter the trade. So you've identified the setup on the 1 hour chart. Now what? You drop down to the 2-minute chart. You mark the middle candle's high or low, and you wait for price to break that level with strength. This is important. You don't take the first break. You wait for a strong, clean break with follow-through. If price breaks weakly and immediately pulls back, skip it. Wait for confirmation. Once it breaks and closes above or below that middle level with strength, you take the trade. Your target? The opposite end of that 1 hour candle. And here's the most important part. You always aim for a 2-to-1 risk-reward ratio. That means if you risk $10, you're aiming to make 20. If you risk 50, you're aiming for 100. Why does this matter? Because even if you lose 2 trades and win 1, you're still break even or slightly green. That's how you stay profitable long term. The times that work best now. This setup works literally any time of day. But I've found 2 windows where it's most consistent. 9:30 a.m. to 1 p.m. Eastern Time, and 7 p.m. to 10 p.m. Eastern Time. Those are the sweet spots. But honestly, if you backtest this, you'll see it works around the clock. I've tested it during overnight sessions, early morning, late afternoon. It doesn't matter. The setup still appears and still works. Why this works? Here's the thing people don't understand. Price doesn't move randomly. It moves to liquidity. Every time price breaks a level and reverses, it's creating a trap. Traders who chase the breakout are now stuck, and price is going to sweep them out on the way to the real target. Candle range theory is just a simple way to identify those traps and trade them. The beauty of this setup is that you're not predicting where price will go. You're reacting to what price is already showing you. You're letting the market tell you where it wants to go next. Real results. I've been using this strategy for years, and when I backtest it, I consistently see win rates in the 80 to 90% range. Does that mean every single trade wins? No, of course not. But when you combine an 85% win rate with a 2-to-1 risk-reward ratio, the math works in your favor every single time. That's the difference between gambling and trading. You're playing a numbers game where the odds are stacked in your favor, your homework. I don't want you to just take my word for this. Go back and look at the 1 hour chart yourself. Pick any futures contract, NQ, ES, gold, whatever, and count how many times this setup appears and works. I guarantee you're going to come back and say, holy crap, this actually works. Because when you see it with your own eyes, it clicks. You can't unsee it. Final thoughts. Look, I've been testing strategies for years, and I keep coming back to 2 setups. Candle range theory and breaker structure. Fair value gap, why? Because they work, they're simple, and they don't require you to sit in front of the screen all day. So go test this. Don't trust me, trust the charts. And when you see how clean this setup is, come back and let me know in the comments. As always, manage your risk, trade smart, and I'll see you in the next one.